Let's have a look at the 10 sum from the Deposition Accounting chapter of Standard 11. This sum consists of two machinery being purchased by Rahul, one on the 1st of April of 2014, which is for 2 lakhs, and the other is on 1st of October 2015, which is for 1,20,000. And in this sum, he is selling off the first machinery which he has purchased for 1,20,000 on 30th September 2016, and the second machinery stays with him. So we are going to provide depreciation for both the machineries, the one which is being sold, the first machinery and the second machinery, and we have to show this working note or providing depreciation in the machinery account, and we have to open the depreciation account. So first let's see what all they have given. Let's take and write what all they have given for machinery 1 and 2, and let's start with the working note. So in my account sheet, I have written out the details which is given in the problem for both machinery 1 and machinery 2. So by doing this, it is easy for us so that we need not go back to the sum, read the sum again and then do. So it is cut and clear that what all is given for machinery 1 and what are the details given for machinery 2. So first let's start with machinery 1 and do the working note. The first step in the working note is calculation of dates. So we must start the calculation of dates with the date on which we purchased the first machinery. So 1/4/2014, and the accounts are closed on 31st March of every year. So 31/3/2015. Why? Because after April, the next year only we will come to March. Then the second year depreciation we have to start with April. So after March 2015, immediately we have April over there. So 1/4/2015 to 31/3/2016, and in this first machinery we must remember that we are selling the machinery on should remember that we are selling the machinery on 30th September of 2016. So we must close this machinery on 30 September 2016, because after that we will not have the machinery in our hand. So we need not wait till 31/3/2017, because the machinery won't be there in our hands on 31/3/2017. So we must close this last year of depreciation on the date of sales. Next, calculate the number of months for each year of depreciation. So the first year of depreciation, we are going to give depreciation for the full year, that is from April to March. So it is going to be 12 months, therefore 1 year depreciation. The second year also is from April to March, therefore 1 year depreciation. But if you take the last year, that is the third year depreciation, it's only from April to September. Therefore we are going to provide only 6 months of depreciation for the third year for the first machinery. Next, let's start with the working note of the first machinery. Always working note must start with the original cost. So here if you see, we don't have any repairs or charges as such, therefore the cost of the machinery will become the original cost. So write the date of purchase, that is 1/4/2014, in the date column, and you can write the cost of the machinery in the particulars column and write the amount in the amount column. We can use your account sheet itself and do the working note. So the cost of the machinery is 2 lakhs, therefore let's write 2 lakhs over there. Next, we are going to provide depreciation for the first year. So always depreciation is provided at the ending, that is closing date. So in the calculation of dates for the first year, the closing date is 31/3/2015. Therefore on the date column, write 31/3/2015 less depreciation first year, and below it itself we can do the calculation. So we're going to provide for 1 full year according to our calculation of dates. So 2 lakh into 10% into 12 by 12. 12 by 12 is nothing but 1, so I'm not going to write that. So 2 lakhs into 10%, simple, I can just remove 1 0 from 2 lakhs, which will give me the answer for 10% of 2 lakhs, which is 20,000. So write the 20,000 below 2 lakhs and subtract it. So when you subtract it, the balance for that first year depreciation will be 1,80,000. Next, write down the date, that is the closing date of the second year, because the opening date, that is 1/4/2000 and 15 we didn't purchase anything, therefore it is only 31/3/2016 which we are going to use for providing depreciation. So write the closing date for the depreciation for the second year, and again the same procedure. You can write down depreciation second year and do the calculation below it as 2 lakh into 10% again, and we are providing for one full year, so we need not write 12/12. So again, since this is original cost method, we are using the original cost. Again 2 lakhs only will be used for each and every year's depreciation. So 2 lakhs into 10%, we will get 20,000. So 1,80,000 minus 20,000, we'll get a balance of 1,60,000. Next, let's go to the last year's depreciation. So in the next step, write the date, that is a closing date. Now the closing date will be the sales, the date on which we have sold the machinery. So 39/2016 we have sold the machinery, so write the date and less depreciation. Now this depreciation we're going to provide for only 6 months. So the calculation goes as, again original cost 2 lakh into 10%, that is the rate of depreciation, into 6/12. Why? Because it's only for 6 months. So 2 lakh into 10%, we already know it is 20,000. So 6/12 is nothing but half. So 20,000, if you take half of 20,000, 10,000 is going to be the answer. So this is a simple oral calculation for the final year depreciation. So put the 10,000 over there and subtract it. So when you subtract it, 1,60,000 minus 10,000, you'll get a book value of 1,50,000. Next, we gotta calculate the profit or loss on sale of machinery. So for that, from the book value, we must compare the sale value. So first, let's write down the sale value of this machinery. So the sale value for this machinery is 1,20,000. But if you compare the book value, the cost of the machinery or the worth of the machinery which we have in hand is 1,50,000. So when we sell it for a lesser rate, then obviously it is going to be a loss on sale of machinery. So loss is when you subtract 1,50,000 from 1,20,000. 30,000 is the exact amount of loss suffered by selling this machinery. So after finishing the first machinery, let's start with the calculation of dates for the second machinery now. So calculation of dates, when we start with the second machinery, we are not selling the machinery. So for 2 years we are going to give, that is till 2017. So first we will start with the date on which we purchase the machinery, which is 1/10/2015 to 31/3/2016, which is the first year's date. Second year's depreciation dates are going to be 1/4/2016 to 31/3/2017. The reason why we are stopping with 31/3/2017 is, in some also they've said to give till 2017, and if you see the first machinery, we have sold it on 39/2016. So accounting year closes for the first machinery for 31/3/2017. Therefore, for the second machinery also we are closing at 31/3/2017. So now we must see how many number of months we are going to give. So the first year depreciation, if you see, it is only for 6 months. That is starting from October to March. It's only for 6 months. Next year depreciation, if you see, it is for the full year, that is April to March, therefore 12 months. So next step, we are going to start with the working note. Working note, always we must start with the original cost. Here also there is no repairs or charges as such to add for the original cost. Therefore the cost of the machinery will become the original cost of the machinery. So write down the cost of the machinery with the date on which you purchased it. So 1/10/2015 cost of the machinery, which is 1,20,000. Now next we are going to provide depreciation for the first year of the second machinery. So it's only for 6 months under straight line method. Therefore less depreciation first year. We can do the calculation below it. So 1,20,000 into 10%. Since it's for 6 months, we have to write into 6/12. So 1,20,000 into 10% is 12,000. And half of 12,000 is 6,000. So the first year depreciation is going to be 6,000, which is going to be subtracted from the original cost, which is 1,20,000. So when you subtract it from 1,20,000, you will get 1,14,000 as the balance. Next, we are going to give the depreciation for the next year. Therefore, second year closing date 31/3/2017 less depreciation for the second year. Again, original cost, which is 1,20,000 into 10%, and this is for the full year. Therefore, 12/12. So 1,20,000 to 10% is going to be 12,000. So subtract the 12,000 from the 1,14,000 which we got. So when we subtract it, you will get 1,02,000 as the book value. So this is the book value for the second machinery. There is no sale value since we didn't sell the second machinery. It's only the book value which we have, which will be reflected as a balance carried down in the machinery account for the last year. Let's start with machinery account. So take a double page since it's a ledger account and write the heading as machinery account, and the same format for which we follow for the ledger account is going to be followed here. So the debit side, date, particulars, ledger folio, amount and amount. Likewise, credit side also, date, particulars, amount and amount. So when you start with the ledger account, you must be careful. By now the sum should have gone inside your head. That is, you should have at least understood the sum, the dates, the amounts should be remembered by you. So first let's start with the first machinery which we bought previously. So on the debit side, so if you take the machinery account and the depreciation account, it is based on 5 journal entries. One is the purchase of machinery, then the depreciation, then the transfer of the depreciation to the profit and loss account, and fourth is the profit, fifth is the loss, and lastly we have sale of machinery. So based on these journal entries only, we are going to do the machinery account, but they have not asked us to give the journal entries in the sum, so we are going to do the journal entries orally and we are going to record it. So first we are going to record the purchase of the first machinery. So the journal entry is machinery account debtor to bank. So when we are doing machinery account, in the journal entry machinery account is in the debit, therefore we should go to the debit side and write to bank over there and record the amount of 2 lakhs there with the date of purchase 1/4/2014. Next we got to provide the depreciation for that year for the first machinery. So when we go to the working note of the first machinery, we can see 31/3/2015 we have given the first depreciation. So write down the date, and the journal entry for the depreciation is depreciation account debtor to machinery account. So machinery account is in the credit, therefore go to the credit side and write the opposite account's name, which is by depreciation with the date 31/3/2015, and the amount of depreciation is clear in the working note, that is 20,000, which you can write it down here in the machinery account. With this, the first year depreciation is over, so we are going to balance the machinery account for the first year, that is from 2014-2015 we are going to balance it. And you must remember the second machinery was bought in the second year only, that is 2015-16 only we have bought the machinery, that is the second machinery. Okay, so the first machinery we have to balance it now. So draw the grand total on both the sides, and the highest total is 2 lakhs, so write that as a grand total on both the sides. Now the side which is least is the credit side. So come to the credit side, and the last date, the closing date of accounts is 31st March of 2015, right? By balance carried down, and subtract 2 lakhs from 20,000, you'll get 1,80,000 as the balance carried down. Now take that carried down to the opposite side and write it as 1/4/2015 to balance brought down 1,80,000, and we're going to carry on with the sum for the second year, that is the year between 2015-16. So for the second year posting of depreciation in the machinery account, we are first going to give depreciation for the first machinery which we bought. So the second year depreciation for the first machinery, the ending date, that is 31/3/2016 we are going to give the depreciation. So write that down on the credit side, the same set of journal entries, that is depreciation account debtor to machinery account. Since we are doing machinery account is in the credit of the journal entry, therefore go to the credit side and write the opposite account's name, which is depreciation, and write down the amount which we can take it from the working note, which is 20,000 again. Next, now in this year, during this year only, we have bought the second machinery. So the second machinery we have purchased it on 1/10/2015. So the journal entry for the purchase of machinery is machinery account debtor to bank account. So go to the debit side of the machinery account and write the opposite account's name, which is to bank for the second machinery. So we purchase a second machinery for 1,20,000. So write that amount down on the debit side. Next, on that same year, we are supposed to give depreciation for the second machinery also. So the closing date of that year, 31/3/2015, by depreciation for the second machinery is supposed to be recorded on the credit side of the machinery account. Why? Because the same journal entry to be followed, depreciation account data to machinery account. Since machinery account is in the credit, therefore go to the credit side and write the opposite account's name, which is depreciation account. And the amount of depreciation can be taken from the working note, which is 6,000 rupees. Now after recording these, we are going to balance it like no other ledger accounts. So we are going to balance the ledger account. There is a small correction in the dates. The closing date is 31/3/2016. Provided we leave out the first year. We are doing second year, so start from the second year alone. Right? So take the greatest total and put it on the grand total, which is 3 lakh. That is the debit side total. 1,80,000 plus 1,20,000, we get 3 lakhs. And subtract it from the credit side total, which is 26,000. You get a balance carried down of rupees 2,74,000. Now take that carry down and take it to the opposite side as brought down, which is 2,74,000 again, with the starting date of the next year, that is 1/4/2016. So now we should remember the last year depreciation we are going to provide. So the last year depreciation, we are going to sell the first machinery and the second machinery is going to stay along with us. So first finish of the first machinery's depreciation. So after two balance brought down, on the credit side we are going to record the depreciation for the first machinery. So that's going to be only till September 30/9/2016. So by depreciation, and we can take the amount from the working note. So record this on the credit side. Again, the same journal entries are going to be followed, therefore only it is going to come on the credit side. So by depreciation account, and the amount is going to be rupees 10,000. Now we are going to sell the machinery. Either you can finish off with the first machinery and then go to second machinery, but now I am going to do the second machinery depreciation and then going to sell the first machinery and get the profit or loss, record the profit or loss. So the second machinery's depreciation is going to be recorded on the last date of that year, that is 31/3/2017. So that's going to be for one full year. We can take the amount from the working note, which is going to be 12,000. So record that on the credit side again for the second machinery's depreciation. Now when we sell the machinery, it is just the opposite journal entry which we are going to do from purchase of machinery. So when you purchase machinery, it is machinery to bank account. When you sell, just the opposite, bank account data to machinery account. So machinery account is credited, therefore come to the credit side of the machinery account and record it as by bank account 1,20,000. Next we are going to record the loss on sale of the first machinery. So loss on sale of first machinery will be recorded on the credit side of the machinery account. The journal entry goes as profit and loss account data to machinery account, which is the journal entry for the loss on sale of machinery. Therefore on the credit side it's going to be recorded as by profit and loss. If you want, in the bracket we can write it as loss on sale of first machinery. So the loss on sale of first machinery, the amount can be taken from the working note of the first machinery, which is rupees 30,000. With that, the third year of the machinery account is over. We have to balance it. So again, draw the grand total, and the grand total, the highest total is going to be 2,74,000, which has to be written on both the sides, and the lease side is a credit side. Therefore the last date, that is 31/3/2017, by balance carried down. So the balance carried down is nothing but 1,02,000. Now take that 1,02,000 and put it in the opposite side as brought down. With that, machinery account comes to an end. Next, let's start with the depreciation account. So the depreciation account, the same format which we follow for the ledger account is going to be followed here. And depreciation account is a very easy account where on the debit side we are going to record to machinery account, and on the credit side we are going to record by profit and loss account. Other than this, we are not going to record any other account's name in it. And likewise, how we do machinery account for the 3 years we are going to do. So we can look into the working note, and we are going to record the amount of depreciation in the 3 years for the first machinery and for the second machinery. So the first year depreciation is for the first machinery, which is on 31/3/2015, 20,000 rupees. So on the debit side to machinery account 20,000, and on the credit side by profit and loss account to 20,000. Next, in the second year depreciation, we are going to give depreciation for the first machinery and the second machinery. Therefore, in the working note, second year depreciation of the first machinery amount to be taken, and the date also to be taken and recorded on both the sides of the depreciation account. So 31/3/2016 depreciation for the first machinery on both the sides, the amount is going to be again 20,000, and the second machinery 31/3/2016 again, but the amount of depreciation is only 6,000. So come back to the depreciation account. Debit side, 2 times you are going to write two machinery account and two machinery account. Why? In the sense, first machinery, second machinery. Likewise, credit side by profit and loss account, by profit and loss account. And this is a self-balancing account. Therefore, we can balance it then and there. You won't get any carried down or a brought down in a depreciation account. The last year's depreciation, again 2 times you are going to write the machinery account and the profit and loss account. The last year depreciation for the first machinery is going to be only 10,000, and it is going to be dated 39/2016 on this sale date, which you can take it from the working note. And the second machinery is going to be 31/3/2017, the last date on which accounts are closed, and the amount of depreciation also can be taken from the working note, which is going to be 12,000.